Hey guys, it's Kyle with Fundamentals of Finance, and today we'll cover the four most common ways to save, which are savings accounts, high yield savings accounts, money market accounts, and CDs. And there's a fifth way that beats them all, and it's not even close. Spoiler alert, I'm talking about municipal bond funds, which you can buy on your Schwab or Fidelity account, but we'll get to that in just a second. Just a level set before we get started, these are all ways to set up your rainy day fund. Your emergency money that you hope you'll never have to use, but need to keep safe and readily available just in case you do. This is not your swing for the fences money, so everything we're going to talk about today is very far on the safe and conservative side of investments. The rule of thumb is to keep 3 to 6 months of your basic living expenses in some type of savings. And of course, that varies by person and how fast you can find a new job, how many kids you have, etc. But that is a good general rule of thumb. Now, on to the 5 ways to save. And by the way, not many people know about the fifth one, the municipal bond funds. So if you've been using one of the first 4, please don't take this the wrong way. The most important part is that you've been doing something. From here, I'll make you smarter and help you make sure you're getting the most out of your rainy day or emergency fund. Let's start with the most common method, a savings account. I looked up the rates at a few common banks. At Chase, it's 1 basis point, which means 0.01%. You need to have this term down, basis points, because it is commonly used in the investing world. 100 basis points is 1%. 10 basis points is 0.1%. So in this example, the Chase savings account pays 1 basis points annually on your savings. So let's pick an amount, say $1,000. That means for every $1,000 you have invested there, you'll earn a whopping 10 cents in interest per year before taxes. At Bank of America, you get the same rate. Oh, unless you're a super important diamond or platinum honors member, in which case you can get 4 basis points or 40 cents for every $1,000 you have in savings. And that's also where the rates at Citi start, but they can go all the way up to 15 basis points or $1.50 a year for every $1,000 that you give them. Oh, as long as you have at least $500,000 in your savings account. And let me just say this, by the way, if you have $500,000 in a savings account, good job saving, but probably not the best idea. Let me just say, I'm glad you're here. Now, let's say you want to earn a bit more, so you decide to go to a high yield savings account. Sounds super sexy, right? I remember when I was like 12, I was like, who wants a low yield savings account? Everybody should have a high yield savings account. I'm only going to buy a high yield savings account when I have money. Well, a high yield savings account and a savings account are essentially the same, except usually offered by an online only bank. The high yield savings account is usually only offered by an online only bank that can give you a little more interest because they don't have to pay as much overhead for branch locations, employees, etc. Sometimes these will have little limitations like a maximum amount of monthly transfers, but usually nothing too important. According to bankrate.com, the top high yield savings accounts for April 2022 yield between 0.5 and 0.75%. That means for every $1,000 you have invested there, you'll earn about $5 to $7.50 per year in interest. Again, this is still before taxes. Is $6 better than 10 cents? Sure. Will it ever be a big enough difference to notice? Probably not. For our purposes here, the third one is a money market account, which is essentially the same thing as a high yield savings account, just with some checking account-like features. The main advantage of the savings account, high yield savings account, and money market account is that they are typically FDIC insured or NCUA insured if they're at a credit union, up to $250,000. Essentially, this just means that you will have your money if the bank goes out of business. In other words, the government will make sure you don't lose your savings. It sounds nice, but ultimately the odds of a major bank failing and depositors losing their money is so low anyway that I'm not sure how much real value there is in that insurance. It was more important in the 1930s, but now it's mostly psychological. Now, we mentioned money market accounts earlier, but I'll just briefly mention that those should not be confused with money market funds. These also pay very low interest rates, but are not FDIC insured and are not as good of a vehicle for saving. Mostly you would own one of these in an investment account if you want to have some money in cash that's ready to invest when you find something attractive. Our fourth way to save, which can challenge savings accounts for the worst of them all, is CDs. Banks love to say these because they don't always have a lot of other things to offer, but there are so many better options for almost any situation. Like savings accounts, high yield savings accounts, and money market accounts, they are also FDIC insured and they can pay you a little bit more than the other options. But they come with one significant caveat. You lose one of the most important functions of your emergency money, the availability of your money in emergencies. With the CD, you have to lock in your money for a certain period of time, usually between 1 month and 10 years, and you have to pay a penalty to take it out earlier. So for example, Bankrate.com's top 2-year CD pays 1.4%, and the top 5-year CD pays 1.8%. So still not very high, you still have to pay taxes on it, and you lose the ability to take it out anytime without a penalty. No thanks. This brings us to our fifth option, and the one that I personally prefer strongly to the other options. For most people whose emergency fund would just sit there for a long time and rarely be touched, you can be significantly better off in the long run by going with a conservative, short-term municipal bond fund, especially a state-specific one if you are paying state income taxes like in New York or California. Why are these so much better? Well, the short answer is because you're highly likely to have more money in the end. The reasons are twofold. First, while yields will fluctuate from fund to fund and over time, they'll almost always be higher than the other options we've talked about here. Second, every other option except this one is taxable. So if you're in the 25% tax bracket, you get to keep 75 cents of every dollar you earn on a savings account or any of the other options we've discussed. Municipal bonds are federally tax-free, and if they're issued by any entity in the state you live in, they're usually state tax-free too. So when you make $1, you keep $1. There are two downsides to this approach, each of which pale in comparison to the upside, in my opinion. The first downside is that they are not FDIC insured. However, that's not as relevant because FDIC insurance has more to do with the bank business model than municipal bonds. With banks, lots of people deposit money with them, and everyone can theoretically get it out whenever they want. However, in reality, the banks lend some of that money out on a longer-term basis for things like home, car, and business loans. That's how they make money. So in reality, they couldn't really give everyone all their money back at the same time. FDIC insurance protects savers if everyone wants their money back at the same time, or if the bank made a bunch of bad loans that they're not going to get paid back on. That's not as relevant for a municipal bond fund, which is invested in bonds, aka loans, to lots of different state and local entities such as governments, hospitals, and toll roads. Even if a hospital goes bust, it's not going to have an impact on the toll road. And even if a state has trouble paying their debts, they can always raise taxes. Now, there are some municipal bond funds that are more risky and pay a higher yield, like 5%, but that's not what we're talking about here. We're talking about high quality, short-term municipal bonds. The second downside is that there is some small amount of volatility with these. AKA, if interest rates go up, maybe you could lose 1 or 2% in the short term. But again, I'm advocating for the really conservative stuff, so there won't be that much downside risk. And even if you had 97% of your savings available to you, it will probably get you through your tough time just fine. So yes, there is more risk of losing money, but only a very small amount. And the overwhelmingly more likely scenario is that the money just sits there and earns more than it would in any of the other options, and tax-free. Over time, this can make a huge difference. Let me show you. Let's take Vanguard California Intermediate Tax Exempt Fund, for example. The ticker symbol is VCAIX. It's been around since 1994. It's inexpensive, highly rated by Morningstar, and the bonds that it holds have an average credit quality of AA, which is the second highest level possible. Looking at monthly rolling 1-year periods since its inception, so like the 1-year period starting on April 1st, 1994, then the 1-year period starting May 1st, 1994, and so forth and so on, the fund went up about 92% of the time, and the absolute worst you could have done for any 1-year period was negative 4.28%. If you instead looked at rolling 2-year periods, your odds of losing money were almost zero. In fact, there are only 2 periods where it went down, and the worst one was by 0.16%. So your $1,000 turned into $998.40 and then quickly recovered. Over 3-year periods, you never lost money, and in fact, never had a return lower than 1.2%, about double what you're getting from a supposedly high yield savings account. And it's tax-free. But I think in the investment world, we talk in percentages too often, so let me translate this into real dollars to show you the impact it can have over a long period of time, like 20 years. Let's say your savings are built up already and your 3 to 6 months of basic living expenses are $10,000. If you invested that $10,000 into a high yield savings account or money market account paying you 50 basis points or 0.5% a year, at the end of 20 years, you would end up with $11,049. Oh, wait, Uncle Sam hasn't taken his cut yet. Actually, you would have ended up with $10,777 if you were in the 25% tax bracket. However, if you had invested that money at 1.2%, which, by the way, is much worse than this fund has ever done over a 20-year period, you would have ended up with $12,694, a difference of nearly $2,000 on your $10,000 investment. And this estimate is extremely conservative. If you'd earned 3.66%, which is what the fund actually earned over the past 20 years as of March 31st, 2022, your $10,000 investment would be worth $20,522. Making this little switch would have left you with nearly twice as much money over the course of 20 years, and that's assuming you're only in the 25% tax bracket and not paying any state income taxes. Interest rates on municipal bonds, high yield savings accounts, and everything else we've discussed move around over time. So going forward, the results are not going to be exactly like this, but investing is about calculated risk. It's about giving yourself the best possible odds to achieve your desired outcome. The worst 3-year return of all time in this mutual fund since 1994 was about twice as high as what most high yield savings accounts are paying right now. So could it do worse than a high yield savings account over the next 3 years? Yes, it could. But would you bet on it? I wouldn't. Now you may be asking, Kyle, which municipal bond fund should I buy? Well, I can't give you financial advice, but I will tell you 3 municipal bond funds that I like, customized depending on your state. For California, a fund that I like is the one we just talked about, ticker symbol VCAIX, aka the Vanguard California Intermediate Term Tax Exempt Fund. For New York residents, a fund I like is ticker symbol NYF, the iShares New York Muni Bond ETF. Now, I chose California and New York since they both have state income tax and obviously have large populations. If you live in a state with state income tax, try to choose a municipal bond fund with your state in the name, like Wisconsin or New Jersey. For those in Texas, Florida, or other states without state income tax, a fund I like is AFTFX, the American Funds Tax Exempt Bond Fund of America. In another video, we can do a deep dive comparing municipal bond funds or emerging market funds, etc. But today, I wanted to explain the advantages of a conservative municipal bond fund and give you 3 actual municipal bond funds that you can buy on Schwab, Fidelity, TD Ameritrade, etc. The bottom line is that while everyone's situation is different and the future is uncertain, putting your savings in a high-quality municipal bond fund is very likely to leave you better off in the end, especially when compared to a savings account, a high-yield savings account, money market account, or CD. For personalized advice, you'll have to talk to a financial advisor. But for those looking to do things for themselves, I hope this video has helped make you a little bit smarter and over time, maybe a little bit wealthier. If you really want to take your investing knowledge to the next level, check out the webinar below called The 9 Habits of Successful Investors. The link is in the description. If you have any questions, please let me know in the comments below, and I will respond as soon as possible. I do respond to all comments. If there's another topic you'd like me to cover, let me know as well. Thank you for watching, and I'll see y'all in the next video.